Good evening, everyone. Welcome to our Georgia Tech Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Hopefully, you're having a great start to your week. And hopefully, you had a fantastic Thanksgiving day last week. And I appreciate you spending some time with us this evening. This is a class that we provide 4 times a year for the Georgia Tech alumni community, and really get excited to get a chance to be able to share some of this content here with you. Tonight's class runs just about an hour, so we're going to take ourselves just about to the top of the hour. But within that time frame, we're going to kind of weave in some questions, and we'd encourage you to ask those to us on air. You can do so by using either the chat or the Q&A feature within Zoom. I'll be kind of monitoring both of those windows and then be able to answer those questions as we go through tonight's presentation. We'll also carve out some time at the end of tonight's class to be able to kind of take on any other questions that you might have as a group. We're also recording tonight's class, so this will be up on our YouTube channel tomorrow, and we're going to share back all of our slides from tonight as well too. So if you want to kind of refer back to some notes, you can do so with those slides. Well, again, my name is Jason Maida. I'll be your presenter for this evening, and I get a chance to teach classes like this all across the country for our alumni communities that we serve in home ownership, and get a chance to work with clients one-on-one to really help build their home plans for home ownership. And we are a nationwide lender, so we can help support all of our clients in every community across the country. We are the 9th largest lender in the country. And our team in particular focuses on supporting first-time buyers in their home purchase. And I've been fortunate enough this year to be able to help several of your fellow alum kind of go down that path towards home ownership and get the keys to their home. In fact, we have a really cool testimonial that I'll share with you later on in tonight's class. This is our talking points for this evening. We're going to look a little bit at what's happening with the housing market. I also want to spend some time talking about interest rates. We have a lot of conversations happening with interest rates and kind of where they're going to go. So I want to kind of share with you some insight there. Talk a little bit about renting versus buying. Does it really make sense for me? And we kind of look at like a budget analysis. I'm going to walk you through one of our calculators that we use to help support our clients. We also want to talk a little bit about credit. Getting ourselves in the best possible position from a credit perspective is super important because it can help reduce down borrowing costs. And then I want to look at some of the programs that are available to us as future buyers. From there, we're going to talk a little bit about a savings plan for home ownership. That tends to be one of the bigger challenges, I would say, for some of our buyers, is just saving up enough funds for home ownership. So we'll walk through that, as well as first-time buyer programs that are available to you. And then one of the most important components of this class is talking about what the buying process looks like. Where do I go from here? So I hope you're going to get, 1 or 2 key things that you can take away from tonight's class that will help kind of get you on that path towards home ownership. But really, where do we go after that, right? So I'm going to walk you through the buying process as well in the latter part of tonight's class. All right. So that's our plan for tonight. Again, our runtime is going to take us up to about the top of the hour. But if you do have questions, please feel free to use the chat or the Q&A function within Zoom. All right. Okay, let's go ahead and dive in. And let's first of all talk a little bit about buying. Does it make sense for me? Because this is going to be really the biggest financial decision that you're going to be making. In fact, just before tonight's class, I just finished up a consultation with clients that are in escrow to purchase their home in California. And, they never thought this was a dream that they could really achieve. And it is such an exciting time, but it's also a big financial move for us, right? So when we think about homeownership, I would encourage you to think about some of the benefits that come along with homeownership, especially when you compare that to maybe your situation with renting today. Things like the ability to control like what my payment looks like, my budget looks like when I'm a homeowner versus waiting for a landlord that's probably going to increase my rent every year, right? The ability to be able to, at some point, refinance my home. So being able to reduce down my expenses because interest rates have gone lower on the mortgage market. Also, this is an asset that will hopefully work for you over time. As that asset goes up in value, as I pay down my mortgage, I create home equity for myself. For most of us that are homeowners, that's probably our number one asset next to maybe our retirement or 401k account. And there still can be some tax benefits that come along with homeownership, potential tax deductibility of interest, as well as when I make energy efficient improvements to my home, having the ability to deduct some of those improvements or upgrades on my home. So when we think about home ownership, it's really not like an apples to apples comparison because there's so many great elements that go into home ownership that we don't get to take advantage of as renters. And so when we think about our budget for home ownership, I always like to start our class by looking at a rent versus buying calculator. It's one of our tools that's available to our home buyers that we support across the country. So I thought I would kind of walk our class through like a real-time example of what renting versus what it could look like versus buying. So let's take a look at this calculator that we put together. And by the way, we have some other calculators on our website that you can take a look at. You can see these on the kind of the header here, whether it's affordability, buying down my interest rate, when it's the right time to refinance. All those calculators you can kind of take a look at and utilize for your own benefit. But let's look at this rent versus buying calculator. And like I said, I'll kind of walk you guys through it. And it starts with the price of home that I'm going to buy. So in this example, we put a $450,000 home price. Someone that's going to put 3% down as a first-time buyer for a conventional loan. That means I'm going to finance 97% of the purchase price, which would be $436,500. We put an average interest rate of about 6.1%. We have a fixed term of 30 years for a mortgage. So that's what most first-time buyers will do, is a 30-year term loan. And then we have an assumption that we'll buy sometime in the month of December. Now, when we put less than 20% down, there is mortgage insurance. So we have PMI, or private mortgage insurance, noted here. We're going to talk more about PMI a little bit later in tonight's class. Then we factor in homeowners insurance, taxes for my home. And if I'm considering buying maybe a townhouse or a condo, then we have HOA dues. All right. So those kind of go in my home buying budget scenario. Now, one of the elements that we want to think about with homeownership is, what does my tax bracket look like? Because I can potentially deduct interest on my mortgage. So this assumes someone at a 25% tax bracket. We also want to look at expenses for my home. So we want to put that into the equation. And eventually, I'm probably going to sell my home. So what are the costs going to be for that? And then appreciation for my home, which is going to be the big advantages of home ownership, right? My home hopefully will appreciate, anywhere between 3 to 5% maybe on an annual basis. Certainly that also depends on where I'm going to buy in the country. And then on the renter side of things, we assume that we're paying $2,000 a month in rent, that our rent costs for renter's insurance is 1.2% of that rental amount, and that our rent will appreciate or go up by 2% on an annual basis. So if we look at our calculator on a side-by-side comparison and we say, okay, so I'm paying $2,000 a month in rent. I really want to buy a house for $450,000. At the end of 3 years, it will make more sense for me to be a homeowner versus being a renter. So that's like my break-even point. So after 3 years, which is honestly a pretty short period of time. Now, if I'm looking at a cheaper priced home, that break-even's even faster. Now, if we span out over 10 years, at the end of 10 years, I'm now $100,000 ahead by being a homeowner versus a renter. And that's really kind of where the magic is in homeownership, if you will. So when you look at over a certain amount of time, as you bake in appreciation in my home, my tax deductibility of benefits, my energy efficient upgrades, that's where I'm going to start to see really the fruits of homeownership versus continuing to rent. So again, someone that's paying $2,000 a month in rent, buys a $450,000 home, they have about a $100,000 upside in homeownership versus renting. Now, if I go out and buy a cheaper home, let's say it's a $350,000 home, we can just change our adjustments here. Now that break even is going to be just even shorter for us. Now it's a 2-year break even. So I would encourage our class, when you have some time, maybe jump into that calculator, run your own analysis to see kind of what it looks like for you if you were to plug in your current rental expense versus maybe your desired outcome of sales price. All right. So that's one of the tools that we offer to our clients. Now, I want to kind of transition now into the housing market and talk a little bit about what's happening in the housing market. Now, it's cold in most parts of the country. Whether you're in the Atlanta metro market, you're in Texas, Colorado, East Coast, or even on the West Coast, it's a colder market right now. So generally, we see a little bit of a slowdown in the housing market. But I think this year's a little bit different, especially as we go into 2026. A lot of buyers are active in today's market, namely because we're starting to see interest rates cooperate a bit. And we'll talk about interest rates in just a few minutes. This is the national housing averages right now. You can kind of see the median sales price here. You can see kind of what's happening with the market. We're kind of leveling out, maybe to a certain extent going up in some markets. Now, depending on where you're thinking about purchasing a home, there are some markets that are a little bit more attractive than others in terms of how much inventory is available. Texas, Georgia, Florida, all have the highest levels of inventory. And let me include in Colorado in there as well, too. So those 4 states have the highest level of inventory right now. So it's more of a buyer's market in those areas. Other markets, it's not so much. It's still kind of more of a seller's market. But we are seeing more buyers come to market, and namely because interest rates are starting to cooperate. So we're watching interest rates really carefully. This is kind of a snapshot of interest rates over the last 25 years. When we have major economic cycles like the housing crisis, the pandemic, we do see obviously changes in interest rates. I always like to kind of share this slide because this gray bar here represents the pandemic, right? Well, we also saw the outcome of the pandemic pushing us to the lowest historical rates have been over, over the past, over the past years, reaching 2.5%. Now, I also spotlight that because some buyers are waiting for interest rates to return to those levels. That's highly unlikely unless we obviously have a big catastrophic event like the pandemic. So probably not going to happen again. But ultimately, historical averages of interest rates are in the high fours to low fives. We still remain above those levels, and you can kind of see this by our chart here. So today's average interest rate is around 6.1 to 6.2%. But we're really watching carefully as to what happens upcoming in the next few months, especially next week, because on Wednesday, the Federal Reserve will give an update, their final update for 2025 on what the Federal Reserve's next move is going to be with monetary policy. So I believe right now there's about a 60-40 chance that the Federal Reserve is going to cut rates next Wednesday. As we get more clarity that the Federal Reserve is in fact going to cut rates, you'll start to see mortgage interest rates go lower. Now, when the announcement is made that they do make a rate cut or maybe keep rates the same, but let's say in a hypothetical, they do decide to cut rates 0.25%, immediately you'll see credit card rates drop, auto financing rates drop, savings rates and high yield accounts start to go lower. We get an indication that they're going to make those moves in the mortgage market, about a week ahead of that. So you'll start to see mortgage rates decline in anticipation of that Federal Reserve announcement. So here's the last 12 months of interest rates. You can see kind of not a lot of activity. But we're really watching carefully on what is being said because ultimately there's two mandates the Federal Reserve has for any adjustments they're going to make on the federal funds rate. One is to get inflation below 2%. Second is the strength of the labor markets. What's happening in the labor markets? Well, just today, ADP released some payroll numbers that actually showed negative growth in payroll. So it'll be interesting to see as we get more data that comes in what the Federal Reserve decides to do. Keep in mind the federal government just restarted, right? Just a week ago. And so a lot of the data reports that we generally get have not been available. So the Federal Reserve has not been able to really consume data to make their decision. And so now some of these numbers are coming out and it might not be as good as we were led to believe in the labor market. So it could push the Federal Reserve to make that rate cut next week. So we'll be watching really carefully. Of course, you can follow us on some of our socials. We'll be kind of posting some of the outcome of that stuff as we get more information next Wednesday. Now, interest rates are not the same for all buyers. I think that's important to understand. Interest rates have different elements that make up the price for you as a consumer. Things like the credit score and your eligibility for a program, the product that you're going to select, what your down payment looks like. If you're deciding to put points out of pocket, which essentially is additional expenses you could pay out of pocket in closing costs to bring down your interest rate. Usually 1 point is the equivalent of 1% of your loan amount, which will translate to about a 0.25% reduction in rate. I don't recommend doing those investments right now, at least, because it's about a 3 to 4 year break even point for points. So I would say, hold on to your cash as a buyer, put more money towards maybe down payment versus buying down an interest rate because most clients are probably going to refinance in a couple of years and you just can't get a good break even when you buy points in today's market. The other thing that can influence interest rates is the term of my loan. Now, most first-time buyers will elect a 30-year term, but if you shrink that down to a 20-year or 15-year term, you can reap the benefits of a potential lower interest rate, usually by somewhere around 0.25% to maybe up to much as a 0.5% difference in interest rate. Now, ultimately, as I get a chance to meet with you to design your own home buying plan, we're going to figure out what that design should look like, given your target budget, sales price you have in mind, and of course, the location that you're looking at for your particular property. All right, let's talk a little bit about credit. And, credit is one of those things that we can identify areas of opportunity for you as we're building your home buying plan as part of our consultative approach. Now, in our class, we like to kind of share with you a little bit more about credit and give you, like I said, some of those areas of opportunity so you can start kind of doing some homework on your own credit profile. Every loan program has a minimum credit score, and you can see some of those programs highlighted here under score requirements. Recently, Fannie Mae announced there is going to be no minimum credit score requirements. However, they do have a scorecard or risk scorecard, if you will. That is not rolled out yet, but they have made the announcement there is no minimum credit score. Today, per the guidelines, there is a minimum credit score of 620. Now, there are three agencies that report out a credit score. That is Experian, Equifax, and TransUnion. You guys are all probably familiar with them. We do take in lending the middle credit score of all three agencies reporting. So let's say, for example, my highest score is 700, then my middle score is 680, and my lowest score is 660. Well, from a qualifying perspective, we're going to take the 680 score in determining the loan product as well as the interest rate option for a client. So let's say that's my middle score of 680. If I have a partner that's going to join me on the application, and let's say their scores are slightly lower, they're at 660, 640, and 620, right? Now their middle score is 640. So then from a qualifying perspective, we're going to use that middle score of 640 to determine which product matches up best. Again, interest rate, maybe even the down payment options for that particular client. All right. Now, on a credit score and how your score is impacted, major events like delinquencies, collection accounts that are written off to charge-offs, they're going to have a bigger impact on your credit score, especially in the most recent 12 to 24 months. In the next screen, we're going to show you a little bit of a matrix that shows you how long they'll stay with your credit report, or credit file, I should say. But in the most recent 12 to 24 months, that's really going to be the impact to your credit score. Here's that matrix that shows you how long a negative event will stay with you on your credit report. Even hard inquiries will stay with you for 2 years. But for inquiries that happen in the most recent 6 to 12 months, that's where you're going to see the impact to your credit score. Now, there are three different models to credit scoring. There's an auto financing model. So if I go buy a car, you're going to have that model. If I'm monitoring my credit or applying for a credit card, there's a credit card model. And then for mortgage financing, we use the mortgage model. That's what you see shown on the screen here today is the mortgage model. Now, when you're monitoring your credit through Credit Karma or any other platform that helps you kind of understand what's going on with your credit file, they are using a credit card score. So there will tend to be a little bit of a variance between what they're showing up on their credit file versus what we show on the mortgage side of things. So different, characteristics are going to be looked at in the credit card model versus what you see on the mortgage score. Here's what the weighting looks like on a mortgage score. So first of all, starts with length of credit. So depending on how long I've had my credit, the probably the better my credit score is going to be. So the more mature, seasoned my credit accounts are, better my score is going to be. 20% is going to be how many new accounts am I trying to open up? Am I opening up new accounts? Am I having a lender do credit inquiries on my credit that are hard inquiries? That can impact my score, especially in that most recent 6 to 12 months. Now, in working with us to design your home buying plan, we only start with a soft credit check. And the reason why we do that is because many of our buyers that we help out throughout the country have maybe a longer timeline that they're going to buy. So we want to help educate them, provide them their options, but not impact their credit score. So we always start with that soft inquiry first. So it's 20% of your score impact if you do a hard inquiry, or again, like I said, opening up new accounts. 30% is going to be around revolving accounts or credit utilization, looking at your credit limits versus your credit balances. Now, the higher that percentage of balance to my credit limit is, bigger impact I'm going to have to my credit score. So here's a really quick tip in how to manage credit utilization. So for example, let's say I have $10,000 in credit limits, right? And my balances right now are $8,000. So I'm currently at 80% credit utilization. If I'm at that percentage, I'm probably seeing a pullback in my credit score, right? So my encouragement or coaching, I guess I would say for our client would be, let's try to get below 50% percentage of credit balances to credit limits. That would give me an incremental lift in my credit score. Now, once I master 50%, let's get to 30%. Then the next or the optimal level is 10% utilization of credit. Now, here's my tip on how to manage that credit card debt. If you take a look at your credit card statement, there's two dates that appear on that credit card statement. One is the billing statement. Two is the due date, right? Most of us are accustomed to paying on the due date, which is totally fine. But if you're really trying to maximize your credit score and get the best reporting out to the bureaus, try and pay off or pay down your credit cards before the end of the billing statement date. And here's what happens by doing that. If you can do that before the closeout of the billing cycle date, what has happened is the credit card issuing company is going to send out all your information to the bureaus at the closeout of the billing cycle date. So if you can catch that before they report, then you're going to get a much lower balance that reports out, show lower utilization, and then lift your credit score. All right. So that's my tip for you around managing that 30% component. And then the last section is payment history. That's essentially how have I paid my bills, right? If I've had any late payments, they're going to be rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. More severe on that spectrum of lates, the bigger impact I'm going to have to my credit score, especially in the most recent 12 to 24 months. Now, to kind of dovetail off of credit, student loans appear on credit, of course. And so in our classes, I like to kind of just talk through student loans a little bit because it is a topic of conversation in most of my consultations I do with clients in designing their home buying plans. Now, right now, student loans are kind of in a weird place right now because some clients are like currently still under forbearance. Some have started active repayment. We've also seen some student loan servicers that are switching up servicing and they've sold their loan to a different servicing company. So it's a little bit of a mess right now. But ultimately, how we look at it from a lending perspective is that if you're currently in active repayment, that is the payment we're going to use, of course, to qualify you. So if you're on an income-based repayment program, and let's say you're paying $75,000 in total balances, but your payment is $250 per month, that's what we're going to use from a qualifying perspective. All right. Now, if you're in forbearance or maybe you're working on your master's program and you're back in school, so you have a deferment, if you're looking to apply for a home mortgage today, we're still going to have to use a minimum payment to qualify you. So the way the rules work in the guidelines is for an FHA loan, we take 0.5% of that $75,000 in debt and count that for the qualifying payment, which is $375. If I'm applying for a Fannie Mae conventional loan, it's 1% or $750 per month. So, that is, how we view student loans. Now, if you're getting ready to restart your payments, and let's say it's like 90 days from now, in order for me to count that payment that's going to start 90 days from now, you have to start making the payment today. So it is kind of like I said, a kind of a weird space that we're in with student loans. We'll help kind of coach and guide you through that, but I want to kind of give you a little bit of an insight as to how we view student loans. Ultimately, that student loan approach is based upon guidelines that are set by the agencies that we partner with. And so we want to talk a little bit about some of those underwriting guidelines for you today from a high level perspective. These are the 5 kind of core programs that we review in our classes. And we'll start with the conventional loan. Conventional loans fall under a Fannie Mae or Freddie Mac loan. And you're hearing a lot of talk around Fannie Mae and Freddie Mac in the news today because there's talk about, privatizing them and, what that can do to the housing market and what the administration is trying to do with that. It's a little bit of a unknown on what's going to happen there. Obviously, there's a lot of things going on in today's market, but ultimately, the conventional loan guidelines require a minimum down payment of 3% for a first-time buyer. And that is someone that's going to borrow up to the conforming loan limit of $806,500. Now, the conforming loan limit gets updated every year. In fact, it just got updated. I think it's 832 now. And that is in place for our financing today. Some first-time buyer programs will implement that new conforming loan limit on January 1st of 26. But that loan limit does change every year. And right about now is when we get the release of those loan limits. So that's the conventional loan. FHA loan is a government insured loan. FHA stands for Federal Housing Administration. That falls under HUD. Minimum down payment of 3.5%. And you can see our minimum credit score for an FHA loan. And then the maximum loan amount's a little bit different. It varies by the county that you're going to purchase in. Now, FHA is a government insured loan, and we're going to talk more about mortgage insurance in just a minute, but falling under a government insured product also is the USDA loan. And the reason why I want to kind of tie those two products together is because there was some changes around eligibility for both products. You do have to be a permanent resident to access any government insured product. Now, if you're a non-permanent resident, you can still get access to a conventional loan because it has different guideline requirements, but FHA unfortunately does have permanent resident requirements. USDA, just below that, is a product that allows buyers to purchase in more rural areas with 0% down. And then the loan amount fluctuates based upon where you're going to purchase. There's 2 qualifiers to USDA. It's the location of the property, but it's also looking at the income as the household. And you have to meet both qualifiers to be eligible for that product. The jumbo loan is going to be for those that need to buy with a little bit more buying power, a little bit more financing. Not really typical for first-time buyers, but it does have higher credit score requirements, higher down payment restrictions. But that is the jumbo loan product. And then finally, we have the VA home loan. The VA home loan obviously supports our veterans that have eligibility on that product. There really is no maximum loan amount for the VA home loan. It is 0% down. The veteran has a lot more flexibility to qualify to encourage that entry towards home ownership. All right. So that gives you kind of a glimpse into loan products. And ultimately, as I get a chance to meet with you as we design your path towards home ownership and ultimately your plan, we're going to figure out which product ultimately matches best for you. Now, inside of those programs, when I decide to put less than 20% down, there's a thing called mortgage insurance. And there's a little bit of confusion around mortgage insurance. So we always kind of like to explain what mortgage insurance looks like. Now, there's two different lanes, if you will, in mortgage insurance. One is PMI, which is private mortgage insurance. The other side of it is mortgage insurance premium, or MIP. That is with a government insured FHA loan. So let's talk about PMI first. PMI stands for private mortgage insurance. It essentially insures the lender against default by the buyer. So if the buyer had some economic hardship, couldn't pay their mortgage, the lender would be protected. Now that PMI is based upon credit score, down payment, and how much you finance. It does have a cancellation option that once I have 2 years in the loan and 20 to 22% equity, I can apply to have the mortgage insurance canceled. All right. So that's one of the big benefits with conventional private mortgage insurance. Now, one of the misconceptions online that you'll see is some of the calculators that you see on some of the sites will have higher mortgage insurance. It's not necessarily calibrated correctly to the three elements I shared with you just now. If we looked at buying or financing, I should say, $450,000 with a conventional loan with 3% down payment, and our credit score is around 740, we're probably looking at about $138 per month for mortgage insurance. Okay. Some of the sites that you might be visiting for your home search might show 2 or 3 times that amount. It's not as expensive as you might think, but as we can increase our credit score, as we can increase our down payment, that mortgage insurance cost will improve. Now, FHA mortgage insurance is a little bit different because there's two components to mortgage insurance. There's MIP for monthly mortgage insurance, which is 0.55% of my loan amount. And then there's upfront mortgage insurance, which is 1.75% of the total loan amount. Now that gets baked into my total amount financed. So it'll be calculated into the total payment that I make as a consumer. FHA mortgage insurance does not have a cancellation option. So the only way I can exit mortgage insurance is if I decide to refinance out of that FHA loan into more of a conventional home loan product. So if we look at FHA's calculation, we have the two forms of mortgage insurance, right? We have the monthly mortgage insurance, which in this case would be $206 per month. And then we have to add on the 1.75%, which would be $7,800 into my total borrowed cost. So FHA undoubtedly is going to be more expensive than the conventional loan. However, as a buyer, not everyone is going to qualify in the conventional product. So, we want to have options and choices as a buyer. So ultimately, FHA can give us a little bit more flexibility when it comes to guidelines. And so when I get a chance to help you with your path towards home ownership, we're going to figure out, like I said, what product matches up best for you. All right. But before we dive into qualifying income and some of the documents that are asked for in the buying process, just want to open it up any questions that you might have from the group. So feel free to drop those in the chat or the Q&A, and I'm more than happy to answer those for you on air. Okay. All right. I don't see anything yet, but again, you can just drop those in there. I'll kind of be watching. Let's talk a little bit about income for qualifying for a home purchase. And before I go through some different scenarios, I did want to pass along some of the required documents that we generally would need in the buying process. So you can see those on screen: 2 years of taxes, usually a couple years of W-2s, the last 30 days or 60 days of pay stubs. And then from an asset perspective, usually verifying the last 60 days of bank statements. Okay. So that's kind of the documentation. Now, let's talk a little bit about what we need to do to validate qualifying income for homeownership. So usually we need to verify the last 2 years of income or educational background. So whether I've been on the job for a year or 2 months, as long as we can put together a 2-year work and or educational history, that's the most important thing. So I could have graduated from Georgia Tech in the spring, just started my job September 1st, and I've only been there for 3 months. But because I can put together a full 2-year work history and or education with my undergrad, I can still meet the qualifying. So there's the misconception out there in the marketplace that I have to be on my job for 2 years to qualify for a mortgage, which is just not the case. As long as we can put together a 2-year work history, that's the most important thing from a qualifying perspective. You could have even a scenario where, let's say you're on a current job right now, but you're getting ready to start a new job January 1, right? You have an executed offer letter, you're ready to go to start next month, but you want to qualify for a mortgage today. We could potentially use that projected or executed offer letter to help you qualify on your mortgage today, even though you're not starting that job until next month, hypothetically, right? Now, with the 2-year requirement, there is some, stipulations to that, because if you're in a situation where you have a base salary plus commissions or bonus income, then I have to show that you've been on your job 2 years if I want to count the bonuses and the commissions into the income calculation. Or let's say I work for a tech startup and I want to include some or restricted stock that I have, right? If I want to factor that into my income calculation, then I also have to show that I've been on my job for 2 years. If I'm self-employed, in that case, I do have to show 2 years of taxes filed consecutively. So if I'm applying for a mortgage today and I'm self-employed, I would have to show my 2024 and my 2023 tax returns filed. All right. If I have 2 employers, let's say I work for 2 different sources of income, I have to show that if I want to use both sources of income, I have to show that I've been working for both employers simultaneously for the last 2 years. All right. Last couple things I just want to touch on with income. Sometimes we'll have clients that have a full-time job, a 40-hour work week job, but they have some extra time on the weekends and they drive for Uber or Lyft or whatever the case may be. That's also a scenario where I have to show that I've been working for both jobs simultaneously for the last 2 years in order to count both sources of income. Finally, sometimes we'll have buyers that will have maybe a partner that is contributing to the household, but the partner has no intention of being part of the application. Unfortunately, unless your partner is going to join the application, we can't use those other sources of income to be able to help you qualify for your mortgage. All right. That gives you kind of some insight on how we view income. Now, we also look at income versus expenses, and we call that debt to income ratio. So we're essentially looking at existing expenses, things like credit cards, personal loans, auto expenses, student loans, like we talked about earlier. But we also want to factor in the housing expense that you're going to be projected, right? That would include the principal and interest of my loan, the taxes I'm going to pay for that house, the mortgage insurance if I'm putting less than 20% down, and maybe I'm buying a condo, maybe a townhouse that might have HOA dues part of that, right? So the debt to income ratio that we evaluate as a lender looks at all of those expenses versus what your pre-tax income looks like. And we look at those figures, as you can see here, like we have an example here. We want to make sure that expenses do not consume more than 45 to 50% of your total pre-tax income. So in our scenario we have here, we have a buyer who's going to have a $2,500 mortgage payment. They have $500 in other debts, and they're making $8,500 a month. So with that expense structure, right now they have a debt to income ratio of 35.3%. So again, the highest we can go is like 45 to 50% for qualifying purposes. I would say the sweet spot or comfort zone for most clients is if we can get that debt to income ratio to 33 to 36%, that seems like a really good target area. But ultimately, everyone has a certain tolerance level for their expenses. But I would say in my coaching with clients, it's probably about 33 to 36%, right? Affordability is one of the number one things that we're looking for homeownership for clients. We want to make sure that not only is it affordable for you to purchase your home, but sustainable, because let's face it, things change for ourselves financially all the time. So we want to make sure this is something that you can weather as a home buyer. Now, I know we have some participants in tonight's class that are joining a little bit late. So if you attended late, not to worry. Everything I talked about earlier in tonight's class has all been it's being recorded right now. We'll have it up on our YouTube channel so you can kind of look back. And I'm also going to be sending out the slides for tonight's class as well tomorrow morning as well. Okay. Okay, the last component to homeownership before we talk about the buying process is really the down payment or savings for homeownership. Now, here are some of the acceptable sources for down payment. We've talked a little bit about bank accounts. Of course, you can use, what sourced assets you have in your bank account. 401ks, 403bs can be eligible. We would always encourage you to talk to your tax or financial advisor before you start accessing retirement funds or brokerage accounts, just so it makes sense for you financially and you don't create a tax consequence for yourself. Gift funds can also be used. That's where a family member is helping contributing to your home purchase. Gift funds do not have a seasoning requirement. So a donor can provide those funds right away. There is no seasoning requirement. However, funds that you're providing always have to be seasoned for at least 60 days. Okay. Now, as I mentioned in the start of tonight's class, like savings is probably one of the bigger challenges for most buyers, right? Maybe I'm new in my career. Maybe I'm trying to whittle down some of my outgoing debt that I have from school, whatever the case may be. So just getting that down payment accomplished can be a big feat in of itself, right? So I wanted to give you a quick little savings plan as a takeaway for tonight's class, just to give you a sense of like, what are things that I can do right now to help build towards homeownership? So let's say I'm paying $1,500 a month in rent, right? And after meeting with me to build your home buying plan, you're like, hey, I think I can pay $3,000 a month, right? I think I can do that based upon the income I'm making. So right there, you have about a $1,500 variance. So what I encourage our clients to do for a savings plan is on the first of the month, when I'm making that rent payment of $1,500, now I'm going to kind of switch things up a little bit and not only pay my $1,500 rent, but I'm also going to get in that habit of putting another $1,500 into my savings account on the first of the month, just like I'm paying that $3,000 mortgage payment. So not only am I growing my savings account, but I'm also getting myself kind of adapted to paying that level of mortgage and payment. So it's not such a payment shock when I eventually purchase my home and I achieve my goals, right? And as you span that over 6 months, now your savings account's grown over $9,000, not including interest that can compound. Also over 12 months, it's like $18,000, right? So, that is the power of savings. And, as we work with our clients, it might not be a now goal, but maybe it's something we can build into over the next 6, 12, maybe 24 months. Now, there are first-time homebuyer programs that can also support you in achieving your dreams of homeownership. There's nationally based programs. There's also programs that are based strictly right in Georgia, or any other part of the country that you're in seeking homeownership. Most states have what we call as an HFA or housing finance agency, and I partner with most of them. But ultimately, what they do is they're designed to support low to moderate income households in home ownership. So what is low income housing? Well, low income housing is generally someone that makes less than 80% of the median income. And then moderate income would be anywhere between 100% of the median income to about 150% of the median income. Now, Freddie Mac, who we mentioned earlier, has a Borrow Smart program for low-income housing buyers. We can get some additional grants. Within APM, we have a nationally based program called Pathway, provides up to 3.5 to 5% of your purchase price in assistance funds. There is no income limits like most first-time buyer programs. In Georgia, there's the Dream Homeownership Program where you can get anywhere between $10,000 to $15,000 for low to moderate income buyers. If you're in California, because I know we have a lot of our tech alumni that are out in California too, I partner with Cal HFA in California, which is the California Housing Finance Agency. There are assistance options anywhere between 3 to 6% of your purchase price, and lower interest rate options as well. Most HFAs across the country are going to have very similar resources. What I found in my work in different states is that the resources, the amount that you can get as a first-time buyer will vary based upon the cost of living of that state. Now, if we were to look at, let's say, an assistance program here in California, for example, if you're buying a $450,000 home, the minimum down payment is 3%. Closing costs generally, most parts of the country, are somewhere around 2 to 3% of your purchase price. So your out-of-pocket expense is going to be about $22,000 to $27,000 if you did not have assistance, and we're looking to buy traditionally with a 3% loan. Now, if you used, say, a Cal HFA program in California or something similar in other parts of the country, then you can get some assistance resources to essentially whittle down that amount of money out of pocket. So there's a program in California called My Home Assistance, which would provide that 3% down payment amount of $13,500. So that in of itself would lower that cash out of pocket. You could also contribute or participate, I should say, in the My Access program. That's 2.5% of your loan amount. So, in a state like California, you could get over $24,000 in resources to go towards your home purchase. And again, other states look very similar, but some of those resources will just be adjusted based upon cost of living. And, offline, if you like, if you're looking in a particular state like Texas, for example, or Colorado or Florida, whatever the case may be, let's talk offline. I'd love to be able to share some of those resources with you because, so many people think that they have to just save and save and save, and homeownership might put them out to a 5 or 6 year goal, but first-time buyer programs can really make it more of a near-term goal for you, right? Okay, we're going to kind of wrap up with our last topic for tonight's conversation. That is looking at the buying process. And as I mentioned earlier in class, this is probably one of our most important parts, not only on top of all the other things we've talked about, but this kind of gives you like the roadmap. Like, where do we go from here after attending tonight's class? Well, I hope you have a few takeaways and learnings from tonight's class, but after tonight's class, we would love to connect with you for a free consultation. So that's where I meet with every buyer that attends our class for a 30-minute virtual session to help you kind of understand more about homeownership. That session does have some prerequisites to it. You do an online profile, we do a soft credit check, and then you upload some documents. But once we understand a little bit more about you financially, then we get a chance to meet for that consultation. And if you're ready to purchase, let's say now or even in the next 12 to 24 months, we design a pre-approval letter for you that allows you to home shop whenever that time is right for you. Now, the pre-approval is good for 60 days, but you don't have to act on that right away. At least just gives you a baseline for eligibility. And we'll customize that pre-approval for you based upon your timeline of ownership, as well as like really what you're looking for out in your home search. So that really kind of launches us out into the home buying path, right? So that's step one. Step two is a home search, right? And that's could be the most time consuming part of the buying process. Some of our buyers, it's like 2 to 3 weeks. Believe it or not, some of it's 2 or 3 years. So it really just depends on what community you're looking to buy in, what particular property you like, maybe a certain school district you want to buy in. I would always encourage our clients connect with a local realtor. We have a fantastic network of preferred realtors across the country that we can introduce you to. But that would be step two. That's the house hunting phase. Now, once you've identified a property that you like and you want to make an offer on that home, then your realtor will help orchestrate and construct an offer for that particular property. Now, that offer might not get accepted by the seller on the first time, might not even the second or third time, but ultimately, once your offer gets accepted, then you move to the next stage, which is step three. In most parts of the country, that's called entering escrow, which essentially means is you have a ratified agreement with a seller, right? So you said, hey, I'm going to buy this property for X price. And then we've agreed to timelines of that transaction. Now, most transactions across the country from the date of acceptance to the date you get your keys and start moving is about 30 days. Now, other parts of the country that are a little bit more competitive, it could be as short as 14 days, but ultimately that's going to be one of the things that you negotiate with a seller. Now, whenever that time comes that your offer gets accepted, the day that that acceptance happens, I'm going to give you a call and say, hey, congratulations, you did it. Your offer's accepted. Let's talk to you a little bit about some of your action items now. Let's schedule you for a follow-up video session so I can work with you on like kind of fine-tuning your home financing for you. So that's all going to happen in the first couple of days once your offer has been officially accepted. Now, you will have action items on your side as a buyer to do things like making your deposit on your house. Most parts of the country, you have to make a deposit of 1 to 2% of your purchase price. That will count towards your total out-of-pocket expense. Okay. Now, that deposit in most parts of the country is protected by some type of contingency that allows you to do some investigative work as a buyer to check on, inspections for the house, see if there's any issues with foundational issues, roof issues, sewage, plumbing, electrical, any of the important things that you have concerns about. As your lender, I'm also going to order an appraisal on your property to make sure the house is worth what it is, what you're purchasing it for. Also, we're going to get your loan approved, right? And so most of those contingency timelines go up to as long as 21 days, but they are there for your protection as a consumer. So if something just doesn't settle right, doesn't feel like the right property, you can exit the contract and not have your deposit be at risk. As we move through the workflow, step four is going to be some of the administrative tasks of your loan. We do things like verify your employment, maybe update your credit file. We're going to kind of just kind of dial in the financing, whether it's the program, first-time buyer assistance program, kind of fine-tune some of your educational requirements. Now, throughout the buying process, once you're under contract, we're also watching what interest rates are doing. We spent a lot of time talking about interest rates earlier in tonight's class, but interest rates change every minute during the trading day on Wall Street. So as the trading day is going, we're trying to strategically watch the market to time things to have you get hopefully the lowest interest rate option available once you're under contract with the seller. Step five is going to be the loan approval phase. That's where an underwriter has officially approved your loan. That usually happens in the first 10 to 14 days of your contract period. Sometimes it's a little bit shorter. As we go through different milestones, you're going to be getting disclosures of your home financing. There's initial disclosures that generate within 72 hours of our consultation with you. Once your rate is locked in, you get another set of disclosures. And then finally, 3 days prior to your closing time, you get a final set of closing disclosures. The final milestone is step six. That's the closing of the loan. That's where you're going to be signing documents in person with a public notary. Most parts of the country, it's called a table funding state. So you sign on that date. We also issue the funds of the loan that same day. That also gets combined with whatever funds you're going to put out of pocket. Once those funds are all settled and reconciled by the settlement agent, then they'll record documents with the local county recorder's office. They'll record a grant deed to transfer ownership to you, and then they'll also record a deed for the loan. And once they get confirmation that those recording documents have all been completed, then we get a chance to call you and say, hey, congratulations, you did it. You're now officially a homeowner. It's by far my favorite part of my day when I get a chance to call one of our new home buyers and say, hey, you did it. I was talking to one of our clients down in Los Angeles earlier today. He's getting the keys to his house tomorrow morning. It's one of the best parts of my day by none. And obviously, it's a huge, huge financial accomplishment. It obviously starts with a classroom setting like this, learning about home ownership, and then moving into the buying process. But once you get there, it's a huge accomplishment. Now, our relationships with our clients don't stop there. We have a very enhanced aftercare process where we kind of watch, what's happening in the market to be able to seize any opportunities for refinancing. We provide you our HomeBot tool so you can kind of manage what's happening with your mortgage and your equity position on your house. And of course, checking in with you on an annual basis, because let's face it, things happen all the time financially for us throughout the year. So we want to make sure we're here as another resource for you. All right. Now, if you're thinking about moving forward in the buying process, like I said, I'd love to be able to connect with you for a free consultation. So it's a way of us adding value to you and helping you prepare for home ownership. I provided our 3-step process here on this screen. But if you do have some questions after tonight's class and just want to get connected with me, just to answer some general questions. I know we have some questions coming in the chat, but if you have some questions on a particular personal situation with your finances that you want to kind of talk through, let's certainly talk about it offline. But this will be kind of the starting point into home ownership. This is what the consultation looks like for you. Understanding about your budget, what resources we need to put around you, understand a little bit more about your expenses versus your income. Just a comprehensive look at home ownership for you. Now, in designing your home buying, we embrace technology in our process, utilizing mobile tools, using AI. Our mobile tool can help you start the application process. You can follow the progress of your loan, even do some quick calculations all on mobile. So that's all available to you with our APM mobile tool. So that's available to you as well. Part of our partnership with the Tech Alumni is we also discount our services for you. So we discount our services by $750, whether that's a refinance or a home purchase. Of course, you have access to our free classes every quarter, and they're all recorded up on our YouTube channel. You can see your list of benefits on your own dedicated landing page with the Georgia Tech Alumni. And we are a trusted provider in the community. We've helped several buyers with the Tech Alumni throughout the year, support them on that path towards homeownership. But we also have other partnerships as well. So if you have friends, family, maybe even some coworkers that might be interested in some of a classroom setting like this to learn about homeownership, feel free to have them check out some of our upcoming classes. We have a full slate of probably over 80 classes that we'll teach in 2026. Just have a couple more classes left for this year, but we'll help educate over 10,000 folks in our markets all across the country this year. So obviously, in these times right now, people still want to kind of be informed as to what's happening out there, even though, we can do some Google searches and all that stuff, but ultimately understanding their options from an expert is going to help them on that path towards achieving, which is going to be one of their biggest financial goals. All right. And one of your own fellow alum had the opportunity to work with us last month. And Hannah and Jesse were just an absolute pleasure to work with. They gave us just an amazing testimonial that, you guys can see on screen. I won't take the time to read it, but I would encourage you guys to take a look at it. They attended a class just like this just a year ago and got a chance to work with me for a 30-minute session. We designed their home buying plan. They found an awesome realtor in the greater Atlanta market, got their keys to their home just last month, and now they're settled in. I think they're watching the Tech games on Saturday and just having a great time. Just a great couple that we had the pleasure of helping. So I thought I would pass that along to you guys. And finally, here's all my contact information. So if you want to reach out to me after tonight's class, there's all my contact information. As I mentioned to you, we do put a lot of information on our socials, things like market updates, what's happening with interest rates, some of our testimonials from our clients. So we'd encourage you to follow us on some of our socials at JMeda Mortgage. And that brings us to the end of class. I do see questions popping in, so I'd encourage you to stick around. And I think we got some folks that are joining us a little bit late. A reminder, we've recorded all of tonight's content, so it's up on our YouTube channel tomorrow, and we will pass along all of our slides. So without further ado, I'm going to tackle all these questions and I'll stick around for as late as you guys need me. But the first question is with interest rates trending downward, is delaying a purchase worthwhile, or does that generally lead to more demand and thus higher home prices at a higher level? What are the pros and cons on historically? What is the better strategy? So great question. That comes up often because everybody wants the perfect storm. They want lowest rates. They want lowest price homes, right? So to your point, you're spot on. As rates go lower, demand picks up. The question is going to be, what inventory do we have? And so most parts of the country still have some inventory challenges. Builders are trying to make up for the gap right now, but they just can't keep up. I mentioned to you the 4 states that have the highest level of inventory: Colorado, Texas, Florida, Georgia. So you do have some advantages as a buyer. So you might want to wait if you're in those markets because supply is still staying pretty high. But I think as interest rates go lower, the competition is going to stiffen up. As we get closer to the traditional, busier buying months, April, May, June, July, August, that's when you're probably going to see interest rates obviously go to lower levels. You'll probably see more competition in the marketplace. And then can you speak about a professional home inspection? When does that happen, or where does that happen in your step-by-step process? So the home inspection would happen once you go under contract with the seller. So there's a variety of different home inspections. A realtor is going to be really the expert to guide you with that. But from my experience, you have home inspections that will do kind of a whole house home inspection. Then you can get a little bit deeper into like foundational inspections, roof inspections, sewer. You can go electrical. There's a whole variety of different things you can do depending on the property. But certainly once you go under contract at step 3, that's when that would initiate that. And then are there any government programs that eliminate the PMI for first-time buyers if the down payment is less than 20%? So not necessarily government insured programs, but you can change up your financing where instead of paying PMI on a monthly basis, you can buy out your PMI either by an upfront amount or you can pay what we call is a lender paid mortgage insurance, where you take a slightly higher interest rate to basically buy out your mortgage insurance. We do have one first-time buyer program that is dedicated more towards low-income housing buyers that does not have mortgage insurance, but there are certain communities that qualify for this program. So if you're interested in something like that, let's talk a little bit offline. We do have some programs that we can look at, but it's a very kind of specific window of communities. In today's market, is it better to get in now and then refinance if the rates come down? So I mean, it's a personal preference. I do think there's opportunities in getting in the market now because, just as we had the previous question, the competition is going to stiffen up, especially in some hyper competitive markets as rates go lower. So the strategy that most clients are implementing now is like, hey, I buy today, especially in like a winter market right now where rates are maybe not the lowest, they're at 6.25, but this isn't probably going to be my forever loan, right? So I'll probably keep this loan for a couple years. And then when refinance opportunities present itself, let's say when rates go to 5.25, that would be the go time for refinancing. Then, we kind of readjust or recalibrate our payment at that time because, rates are much lower. Because at the end of the day, what I pay for my home is the most important thing. The interest rate that I get on my mortgage it can be changed out, right? Because ultimately the markets will change in interest rates and will present those refinance opportunities to me. But what I pay for the home is not going to change. Once I pay that $450,000 for that home, there's no going back, right? So that is some of the strategies certainly that some of our clients are implementing. Are there any options to co-sign with a parent for a first-time buyer? What are the pros and cons? So you can have a parent as a co-signer on traditional programs. So let's say I want to put 3% down for a conventional loan. I can have a parent that wants to co-sign with me. That's absolutely allowed. Some first-time buyer programs will not let you have co-signers just because of the way the guidelines are structured. But traditional programs that don't fall under like agency first-time buyer programs will allow a co-signer. So we call that a non-occupying co-signer. So you're essentially using the financial profile of your co-signer to help kind of maybe close the gap, or maybe you have some challenges from an income perspective, or generally it's income perspective. It's income versus expenses. All right. And then a question came in the chat in case the group didn't see it. So yeah, so we service every state across the country except for New York right now, but New York will come online. We just We're finalizing some stuff in New York right now, but we're in every market. All right. Any other questions from our group? I appreciate everybody sticking around too, and those that joined late again. We'll get you guys all the content from tonight, so you can kind of check out some of the earlier conversations we had. Um, if we're all good on questions, and I appreciate all the great questions, you guys were awesome. We'll go ahead and get everything signed off. Oh, we had one more question come in. What is the website you had used for calculating rent versus buy? So that is on our website. You can access that. I'll have Ken drop that link in the chat right now. Ken's so good. So it's there. So there's the link right there in the chat. You guys can save that to your bookmark that on your browser. But that has all the calculators on it. There's like 5 different calculators that you can use: affordability, buy downs, but the most important one is the rent versus buying. I'll also take you through that during the consultation. So if we get a chance to meet up for that, love to be able to walk you guys through that. And again, hopefully get a chance to connect after today's session. Love to be able to meet each of you and just kind of be just a support mechanism for you on that path towards home ownership. So thank you so much for spending your busy Wednesday evening with us. I hope you guys have a wonderful, safe, healthy, and prosperous holiday season. And we'll see you soon. Okay. Have a good night.